Oh, he's the guy with 4x more followers than you. Yeah, he has more followers. I have no problem with that. Then I was just jokingly to say that it's okay, my portfolio is larger than his portfolio. I mean, yesterday, I just watched Mr. Lu video. He's showing the S&P 500. He's talking about the market over the past 1 week. So I find it quite interesting because the first slides he pulled out was the S&P 500, and then he just overlaid that with the arrows up and down, right? Then he's saying that, wow, market is crazy. Trump is doing all the tariff shits. Market up and down, very volatile, very unusual. Then I was thinking, actually, is it very volatile last week? Or actually the drawdown has already occurred, like, past few weeks, right? Or past 1 month. Because if you look at the scale, right, the bottom is 5,600. The upper limit is about 5,700. So between these 5,600 and 5,700, what's the percentage range, right? Actually, if you do the calculations, is close to 2%. So market up, down, 2%. So I just thinking, right, actually, although let's say if you really do day trading and you observe the market level over a short period of time, right? Yes, it looks like it keep on going up and down. Good news, bad news, crash. I mean, it's still over this band, but actually 2% is not a lot of volatility. This is, to me, it's just like normal volatility. Actually, the big volatility was about 1 month ago when it is not like zigzagging in horizontal band, but keep on like one straight down, right? That's the part that people are scared of, right? Yeah, my take is that don't be worried. If let's say, if you look at the market behave like this and you feel unease, you feel concerned, maybe you need to reset your expectations on how market works, because all this zigzagging, it happens all the time. Okay, this is some chart that just want to pull out over the last week. Yes, really it's the same chart going up and down. But let's say if we zoom out slightly, right, just look at year to date, right? So this chart started from 2025, 1st of Jan. You saw that actually market continue to rally, and that's because, Trump elected, market still have a lot of all this optimism, right? Then around end of February, like the last week of February, we start to see this crash coming down, right? So I think this is the part that people kind of get shocked, because we are used to 2% kind of movement, 3% kind of movement. That's fine. Suddenly you just have from 1 point down by 10% within, let's say, 1 month, right? So people will start to be, alerted and become concerned, like whether this straight line down will continue to go down or not. But if we just observe what happened during last week, was that it seems that market kind of like stabilized a bit, recover slightly. But we at current point, we still don't know, right? It can go up, it can come down, market can do all sorts of things. But it's very hard to make this kind of short-term predictions. But what I'm trying to show here is that from the first chart here, you see the big zigzagging, right? Then you just zoom out, you can see that, okay, this is, you get different kind of picture. And then if you zoom out further by just looking at past 1 year, right? I think two things we can take away from here. The first thing is that, yes, even from a 1 year historical, like 1 year period, this drawdown that we have seen since end of February still looks quite big, relative to the previous period. Because you see, let's say around December last year or around August last year, I think the drawdown isn't as big as compared to the one that we just experienced. So over 1 year period, you can see that, oh, really, it looks a bit of concerning there because of the magnitude of drawdown, right? So that's 1 year. But if you just zoom out again, right, and now we are looking at 5 year, right, you can see that actually that drawdown that we experienced recently, is it a lot? I don't think so, because you just look at this chart, right, just zoom out, and if you can't see it, you maybe need to, your eyes need to do something like this, right? Then you see that actually overall, over the past 5 years, right, yes, it is still trending up. So as long as market is trending up with some volatility, I think that's something that we all should be okay with, because even if those small volatility, you can't take it, then probably you are, over investing, or you're investing too much as compared to how much you can take. Everyone have different level of volatility that they can take it. Beyond certain level, we all will get panic. Even for myself, let's say if today my stock portfolio go down by 95%, I think I will also panic, So everyone who have their own appetite, right? So you just need to look at all this volatility and ask yourself whether you can still take it or not. Or you are actually looking at this kind of volatility and just feel like, actually, I think even more is possible. So that's, I think, looking at charts is not helping us to make the predictions, but it's more like helping us to make an assessment on what's your risk appetite when it comes to expose yourself to stock market. So that's my takeaway from this chart. Again, I want to stress, right? You look at the drawdown at the midpoint, right? About beginning of 2022 until until end of 2022, you can see that that drawdown is still larger than the one that we are currently experiencing. What I want to say is that, let's say if the current drawdown continue, let's say S&P 500 drop down to 5,000, even 4,500, that kind of level, right? It's more comparable to the 2022 period where we have seen some deterioration in corporate earnings and so on. But right now, we still haven't seen it. So it's kind of like just a mild dip. So on this part, I agree with Mr. Lu. We haven't really experienced a big shock yet. And all these big shock, just as a reminder, it will come from time to time. I'm not saying that this is the beginning of a crash. I'm saying that even if market just rebound from here, right? But a big crash could still be coming in the future. We just don't know when. Okay, that's on the chart part. Then if we just zoom out further, if we look at this from 2009 wasn't that far away. It is, like 10 plus years, right? You can see that actually this is like, it has become a smaller and smaller dip as compared to the rally since 2009, right? And of course, if we zoom out further and put it on a log scale, market continue to go up over the long period of time, right? So this is 100 years of data. And if we just look at even longer, this is about 200 plus years of data on a log scale. And this is just looking at total real returns, meaning already minus out the inflations. You see stocks still outperform most of the other asset class. Actually, the most important one is that we just want it to outperform bonds and cash, because I think for most people, aside from the house that you stay in, right? I think in terms of portfolio constructions, I think people put money maybe a bit or a lot in stock market, and then the rest will be in some sort of like fixed income or cash, right? So we just want to be assured that now we are risking our capital in stock market, whether over a long period of time it can deliver more returns as compared to cash and bonds, right? I mean, at least if you look at the past 200 years, right, it is able to outperform, and this is not by a little bit, it is by a wide margin. So when I say we put money in stock market, I'm not talking about, like trading in and out, selling now, buying later, do this, that kind of like, fancy things. It's not like that. It's really just expose yourself to stock market. Just a broad market is enough, and just want to stay invested for a long period of time and just get this equity risk premium or this outperformance over, let's say, bonds. So this is the one that we're betting on when we say we invest for the long term. Not so much about the trading. The trading, that's a totally different game. Other people play it. I don't play it. I don't know whether you play it or not, but that's individual, right? And there's nothing wrong of those approach. It's just that it is different activity, different games. So just a reminder, the US stock market has a proven track record of compounding returns over the long term. By long term, I mean if you're looking at 20 years, looking at 100 years, looking at 200 years, you can see that very clearly. So it has the track record. Stay invested, right, will have a good returns because of all this risk premium, and then market timing, to me, right, is unnecessary. You want to do that as extra, that's your choice, but it is not required. You don't need the market timing to get this kind of returns. You just need to stay invested. Don't be panicked. So with that said, right, this is, I think, the most important concept in investment. If you know that, then the question is, what are you going to do about it, right? So just a side note, recent videos, whether it's Backholder Pod, whether it's my own videos, I noticed that there are more people come into my videos and make the kind of critical comment. And sometimes, let's say if you think my opinions on certain things, or if you think that I don't have the right thinking models, you have better things to contribute, I mean, feel free to leave your comment at the YouTube comments, so that I'll read all of these comment and I will respond to them. Let's say if you say something, I will respond, right? But I mean, the general rule is that if you are being respectful to me, then I will also do the same to you. But let's say if they are, those trollers, right? They come and comment. Of course, I will throw back. It's like a mirror, right? So that's my comment on these few YouTube comments. I just want to give that response. Let's go down a little bit on these comments, right? This person's GTG, he's basically saying that Master Leong YouTube without using clickbait is doing better than you now. Okay, first thing, yes, I think Master Leong video, at least on the view counts, right? It has really, really much more than mine. I think it's like, 3 or 4 or 5 times more than mine. I have to recognize that his video, I think, is very entertaining. Sometimes I want to relax. I also watch his videos. He have, interesting takes on many things. I don't have a beef with Master Leong, by the way, but I'm just responding to the commentators here, right? Then this Malama, which already commented on Backholder and my video for quite a number of times, right? He just responded that, oh, he's the guy with 4x more followers than you. Yeah, he has more followers. I have no problem with that. Then I was just jokingly to say that it's okay, my portfolio is larger than his portfolio. I mean that's kind of like a joke, like, I don't take it too seriously. It's not like I'm attacking Master Leong. Master Leong is a content creator. He create contents. His viewers are happy. I think I'm perfectly fine with that, right? So I don't have any problem with Master Leong. Actually, in fact, I met him. We even have noodles together, chit chat. I consider him as a friend. Although he blocked me on X, I think that's his freedom, right? There's nothing wrong. I don't have a beef with him. So that's my comment. And then I wrote some, like longer piece here just to say that actually it's not intentions to attack him. So don't attack me just because of that one line, right? Okay, so that's my feedback. And I mean, you can pause here to read my post here, but it's not so important. But the important things, like what is I want to bring up here, right, is like, okay, we all watch all these Finfluencers content, whether it's from Singapore, whether it's from US or other places. We all consume all sorts of content on YouTube, on other platforms. As long as it provides entertainment, we learn something about it. I think that's all good, right? Everyone can choose the content that they like. What is different of my content versus the others, right, is that you can ask yourself how many Finfluencers actually shows the track records, shows the entire portfolio, and just explain my mindset of investment, my philosophy of how I construct my portfolio basically, and show the progress over time. Whether my portfolio go up by 30%, I show it, and then I just, yay, see my portfolio is doing good. And when the market dropped by 15%, which is the video that I posted last week, right, I also share, right? So what you can get from my content here is that it is like very transparent in terms of what I share, and you can see the progress from time to time. In fact, the first video that I posted, right, that was November 2020. The first video I already show my portfolio. This is close to $200,000. I'm showing the entire portfolio, let people see, so that you can see that, oh, I just talked about NVIDIA because NVIDIA went up. No, actually, I showed that in my portfolio since the very first video. So it is in there, right? I can't change the content inside YouTube that has already been posted, right? So the evidence is there. So, but when you watch all this video, you just ask yourself, like the content creator that you like, right? Have they shown this kind of progress over time? So, I mean, how many people show these kind of things? I know Joseph Carson show this all the time. That's why I like his content a lot. I actually try to mimic his style, at least from the start, but over time, it got drifted and it's slightly different. But at least that's my approach, right? Then even if you say, oh, you're only showing it in first video, no, actually I posted my portfolio. The entire allocations is there. It's on my X account, it's on my YouTube, it's everywhere. Basically, I'm not shying away from showing my portfolio. This is my portfolio, right? The one that I'm not showing is just that, my specific traits, right? Like let's say if I buy a certain investment, I don't show that on like real-time basis because to me, I don't have much insights to say that, oh, if I buy this investment now, that's the right thing to do, right? I don't want to have that give you that kind of impression. But overall, whether my portfolio do well or not, it depends on the allocations, which I always show. Even let's say when Chicken interview me, I show it again, let people see. If you see you think that I make some comment on Tesla and I'm bullish on Tesla because I'm an investor. Yes, I am. It's shown there, right? You see the entire portfolio. So I have my own bias. I'm showing that to you so that you know where I come from, right? So, but the key thing is that, okay, these are the transparency and the proven track record of building this portfolio from the first video when I just have just below 200,000. Right now, even with the drawdown recently, right, it's slightly above 800,000. So over the last 4 years or so, right, I built my portfolio by 4 times. Okay, that's the track record, right? You can see that. And the things that I did right, the things that I did wrong, I also shared openly, right? But I think maybe you can look at this track record and ask yourself, like, okay, let's say if you like certain influencer, right, have they shown this kind of track record? Are they able to build their portfolio from relatively small amount to a larger amount? And then you can ask the person, like, have you done anything right or wrong, right? So the first thing is that there needs to be some sort of track record. That's what I try to say here. So this is my track record here. I'm not saying that this is fantastic. I'm just saying that to me, the right way of investment is not to say that, oh, I think this investment is good, then just buy this. It's about the ability to build something from small to big, and then this one will continue to grow, and then it will fund the retirement and so on. So that's the goal. I hope that sets like an example to you who are watching this, to at least feel that you can do similar things, it is a form of encouragement. So then now, okay, if we talk about able to build from 200,000 to 800,000, did I say that, oh, I just picked the right investment, I picked NVIDIA, I picked all these things? Actually, that's not the focus at all. Because I think the first and the most important thing is deploying your capital. You can have some sort of like good returns. Let's say you have 30% CAGR for the past 5 years. And if you just play around with a fixed number of dollars, let's say you just put 10,000, you do 30% CAGR for 5 years. From that 10,000, maybe you can grow to, let's say, 50,000 or whatever numbers, right? But it is still small because to me, something that's more important than picking all this investment is you need to deploy your capital. You need to first have active income. You first need to have decent amount of saving and then channel that saving into your portfolio. Okay, I think that's the first step, right? Before we talk about which investment to choose, and people don't talk about that frequently because how much you can invest. Let's say I'm telling you now that over the past 12 months, I DCA on average $6,000 into my portfolio. So that's the amount that I put in. I didn't do a level DCA because, my financial is not like those very stable kind. That sometimes there is, cash needs. For example, December, I didn't deploy. Probably I was on vacation or probably because my money really used to do other things, right? So it's not a flat number. But at least over long period of time, let's say over the past 12 months, you can see that on most months, actually, I'm deploying capital, okay? And the average is 6,000 per month. And if you times 12, right, that's about 70,000 per year. And that is the main one that will propel my portfolio become larger amount. So I think that's the things that I want to encourage you all to do. I'm not saying that you have to do this kind of amount. Let's say if you can do 1,000 per month, just continue to do that $1,000 per month. You should focus on putting that capital at work rather than thinking about, I already have, let's say, 200,000 in my portfolio. I'm thinking of selling, buying. That even if you do it, even you have good investment returns, it's not going to have a decent size of portfolio if you don't have good saving and put into the portfolio. So ask yourself, ask the content creator you really like a lot, and maybe ask them like how much you DCA per month. What's your portfolio 3 years compared to now? Has it grown? Ask that kind of thing so that you can learn the real portfolio construction, learn the real portfolio building over time. So that's my video. That's my content for today. In terms of what to choose, right? Usually people ask me, how do you construct a portfolio? I would say that if you don't have preference, you will just get as diversified as possible. And then you will be getting, like those global ETF, for example, ACWI or ISAC or VWLA. That's not so important. I mean, which ETF to choose, right? I think you can do further research on that. But the more important thing is that if you totally have no view, totally have no idea which investment to choose, right? Then you should choose the one that is diversified across the world and you get something like this. World diversified ETF will have about 2/3 of the money in US and the rest, right, will be diversified across many countries, including Singapore, including China. You can see that China is there, 2.7%. So they have every country, almost every country, right? So this will be a good starting point already. But you say, oh no, I don't want, I think US can buy. Like for example, Mr. Lu always say, start from S&P 500. In fact, all this chart that I showed in the earlier slides, like this is all talking about US. This is all S&P 500 talking about US. And let's say if you don't have convictions to deploy your money diversified across so many countries, right? You think that China cannot make it, you don't want to put your money in China, you just want US alone, then just get S&P 500, right? Then S&P 500, you don't have to show the allocations by country because it's 100% US. In terms of the allocation, you can see that you have 7% in Apple, 6% in Nvidia, close to 6% in Microsoft. This is the allocations that you are seeing here. And of course, you can download the full holdings and look at the full holdings if you like. For S&P 500, it will be 500 companies. So very, very simple, right? So that's just US. And specifically US large cap. And let's say if you say, I really want to have the best one, the tech focused one, then just get QQQ. Then you can see that, companies like Apple, instead of like the previous one, 7%, now you have 9%, right? Nvidia, instead of 6%, here you have 8%. So it's just like more tech focused. And in terms of number of holdings, it's only 100 companies in QQQ. So that's the one that is a lot more focused. Of course, if you get a lot more focus on technology focused ETF, right? Of course, the volatility will be higher. And this is also mentioned by Mr. Lu as well, right? I think whether you want to have some allocations into QQQ or you are happy with just S&P 500, these are the questions that you ask yourself, whether you want to over-allocate into all these tech companies. I think this one I already mentioned, like S&P 500, QQQ. I think these are the one that is like you can put into. No need to talk about individual stocks. That is, to me, not necessary for most people. Of course, for people like me, when I watch, Nvidia GTC, and then I, just feel very pumped because Jensen say a lot of things, good things about Nvidia. I feel pumped about it. Then I want to put some money into NVIDIA, that's my personal preference, right? I would say that out of like 10 people watching this video, right, probably one or two people, maybe just because you follow me because I talk about NVIDIA, the percentage is higher. But if you just walk on the street and then you just pick one person, do you invest in NVIDIA? I'm sure like 99.9% of people will just look at you like, what are you talking about? Like, of course, people don't have that kind of preference, right? Most people, I would say, you don't need to have that. You just need to have the investment into diversified portfolio. I think that's the most important. Then let's say if you have your personal preference, you want to own Apple because you like Apple products, or you are on Instagram every day, you think that Zuckerberg is doing great things, you want to own Meta, that is all personal preference, right? Personal preference is just personal preference. And you want to prefer China, you want to just write into China, also to me that's personal preference. But the problem with China versus US is just that China, they just have lesser, like not as long track records as US. You want to pull 200 years of investment return for China, there's none. Because in about 1949, China just, the stock market closed down. There's no more stock market. You don't have 200 years of data, but US, you have that kind of data. So I think that's the difference. And you just need to make your judgment on where to allocate to. But I would say that the world diversified, right, that is the first thing to go to. And the rest is just overlay with your personal preference of whether you want to pick some individual stocks to make it more exciting or not. So that's up to you, right?